Everyone's saying OpenAI is losing the enterprise market to Anthropic and that large language models are commoditizing. The idea is that all the value will flow to applications that own user context and workflows, while model providers become interchangeable utilities. But OpenAI just locked ServiceNow into a 3-year co-development deal with revenue sharing. That's not the behavior of a company getting commoditized. In this video, I'm going to reverse engineer what OpenAI is actually doing with its enterprise strategy and why the prevailing narratives are probably wrong. If you've been paying attention to the AI discourse lately, you've probably been exposed to some variations of these two narratives. First, that OpenAI is losing the enterprise market to Anthropic, and that's somewhat true. Anthropic's been crushing both product-led growth with Claude Code and top-down sales through AWS, GCP, and Accenture partnerships. Second, that once large language models are commoditized, all value will accrue to applications that own the so-called context graph. That's a view Mark Benioff, who runs Salesforce, understandably loves. But those views are only correct if you naively assume that businesses are static, compute supply is infinite, and OpenAI doesn't make any adjustments to its strategy. Unfortunately, none of those assumptions hold in real life. In fact, there's mounting evidence that OpenAI's enterprise will regain momentum in the first half of 2026 based on a new revenue and engagement model. To understand this, we need to cover a bit of recent history. The second half of last year was about OpenAI doing two things: setting up its ad business and driving inference costs low enough to sustain a free tier. And that free tier is massive. It's 4 times the size of Gemini and 20 times Anthropic. So OpenAI took foot off the gas from enterprise, while focusing on lowering its inference costs to prevent its free tier from bankrupting the company. That diversion created an opening for Anthropic to capitalize, and capitalize it did with style. Kudos to Anthropic. But now that inference costs are under control and the ad infrastructure is in place, OpenAI is revving up its enterprise motions. It started with OpenAI launching a post-sales and consulting arm, partnering with private equity firms to sell AI transformation, and poaching Denise Dresser, the former Slack CEO, as the new chief revenue officer to focus on enterprise. Then, a few days ago, Sarah Friar, OpenAI's CFO, published a blog post on OpenAI's website titled "A Business That Scales with the Value of Intelligence." It reads like an investor update, but it's actually a sneak peek at OpenAI's revenue model for years to come. In particular, she suggests that OpenAI's revenue model will increasingly move from selling tokens through APIs toward outcome-based arrangements where OpenAI shares revenue with its customers. In short, OpenAI will increasingly pursue value-based pricing, taking a fraction of the value created instead of selling raw tokens. Why now? For a while, it's been known that selling tokens via API is a crappy business. It gives more bargaining power to application layer customers while enabling competitors to copy you. This necessitated a new engagement model, where OpenAI or Anthropic gets an explicit cut of the value for every dollar that every agentic application earns. But you can't just raise prices on tokens because that motivates customers to seek out alternatives like open source models. So what's the right strategy to capture more value? Avoid selling raw API tokens while keeping customers happy. Here's a hint. One way is to directly build applications for your largest customers, then take a cut of that revenue. I've been closely tracking OpenAI's enterprise moves for 2 years, and I believe this is the biggest shift in OpenAI's strategy yet. In this video, I'll cover OpenAI's new engagement model with enterprise customers, which maximizes take rates and minimizes model provider churn. 2 additional levers OpenAI can pull to maximize revenue: signals from analyzing more than 400 job openings at OpenAI to reverse engineer its org structure, why the foundation models are commoditizing narrative may age poorly, and what this means for investors and founders who are concerned about building something that OpenAI or Anthropic will eventually make obsolete. So what does that new engagement model actually look like? OpenAI's deal with ServiceNow is the template. Let me walk you through it. OpenAI will co-create agentic apps for the ServiceNow platform, focusing on voice AI and computer use agents. These capabilities are squarely aimed at replacing labor, and they'll be charged on outcome-based pricing. This is a deep product-level partnership, not a consulting engagement. OpenAI will actively shape ServiceNow's product roadmap. They'll provide engineering support for product development as well as proprietary models. And that last part is the kicker. The end result is a platform that's deeply coupled to OpenAI's model, creating what I'd call model stickiness. Plus, it's a 3-year deal. As those agentic features drive revenue, OpenAI gets some percentage of the final revenue, which is presumably much better than just selling tokens. This lets OpenAI maximize its revenue per customer without being yet another LLM provider. So it's a new partnership template that marries consulting with product development, where OpenAI also has real skin in the game. This kind of value-aligned partnership will likely define how OpenAI works with enterprise SaaS companies going forward. As part of the deal, ServiceNow gets 2 unique AI-native capabilities that its SaaS competitors don't have yet. First, proprietary computer use agents. These agents can click through approvals, update records, and push work through the system autonomously. This isn't a chatbot answering policy questions. It's AI executing enterprise workflows end-to-end, navigating the same interfaces human workers use. Second, real-time voice-to-voice AI. These are real-time voice agents that handle last-mile human interactions for IT help desk and customer service. They turn what was previously a staffing problem into an inference problem. These features allow ServiceNow to transition faster into an AI-native platform. Consider what this looks like in practice. A typical enterprise IT help desk might have 30 people handling tickets, approvals, and routing. With this integration, voice AI handles intake. Someone says, "My laptop isn't connecting to VPN." The voice agent understands context from previous interactions and routes appropriately. The computer use agent then clicks through ServiceNow to diagnose the issue, check permissions, execute the fix, and update the ticket, all without human involvement. Humans are only involved for actual escalations that require judgment, like approvals. This isn't adding so-called co-pilot features to existing workflows, which doesn't remove the human inside a process, only accelerates them. This is automating the workflows themselves. So why would ServiceNow take this deal? ServiceNow knows it needs to modernize. Their stock's been crushed. Their current product is rules-based workflows with bolt-on AI features. They could try building AI capabilities themselves, but the features that actually differentiate, like computer use agents and real-time voice, require deep product expertise and GPU-intensive infrastructure that ServiceNow just doesn't have. More importantly, ServiceNow doesn't have access to cheap compute to run expensive models like voice and computer use agents in production, which can cost 10 times or more than standard LLM agents to run. ServiceNow is GPU poor, and they have skill issues with making AI products. So ServiceNow decides to make the Faustian bargain and modernize first with the most bleeding edge tech before its competitors do, and use that to gain market share. The compute constraint angle is important. Voice AI and computer use agents aren't just better models. They require reliable, high-throughput inference with enterprise-grade reliability guarantees. When you're running IT help desk for Walmart, the bar is a lot higher for reliability. You need guaranteed capacity, predictable latency, and a partner who understands how to ship these capabilities at enterprise scale. So yes, revenue scales with compute, quite literally. ServiceNow made a bet. Rather than spend 3 years building inferior versions of these capabilities, they'll bring in OpenAI's Tiger team to do it right. Yes, they give up a revenue share, but they're betting that modernizing into an agent platform lands them more accounts than they'd win with a half-baked internal build. The trade-off is short-term margin compression for long-term market positioning. For OpenAI, these deals are great for 2 reasons. First, the sales cycle accelerates enormously. Co-development with a platform partner means building repeatable patterns once, then deploying them across ServiceNow's entire enterprise base. ServiceNow becomes a channel. Second, the lock-in is real. 3-year commitment. Deep integration that creates switching costs API access never could. ServiceNow is betting their AI roadmap on OpenAI, which means their customers are too, whether they realize it or not. So, is ServiceNow a one-off? The evidence suggests this is the new playbook. Now let's talk about the broader engagement model. The ServiceNow template is just one of the 3 pillars of OpenAI's new revenue model. OpenAI's old revenue model from 2023 to 2025 had 3 components, and all of them were commoditizing. First, APIs. Per token pricing in a race to the bottom, easy to swap for Anthropic or open source alternatives. No meaningful switching costs. Second, ChatGPT Enterprise. Great for initial adoption but insufficient for deep workflow automation. Third, bespoke consulting. Forward deployed engineers doing proofs of concept and custom builds. Valuable for learning what enterprises actually need, but fundamentally unscalable. And it trained customers to expect free labor. The 2026 model fixes each of these problems with 3 pillars. Pillar 1, domain-specific foundation models. Friar's post signals that OpenAI will train domain-specific foundation models, not fine-tuned versions of GPT-5, but actual foundation models purpose-built for verticals like pharma, healthcare, and financial services. These are verticals where demand elasticity is infinite for marginally better intelligence. For these verticals, it makes no sense for OpenAI to release its best domain-specific models on a token basis. It's better to partner with companies and get a double-digit percentage cut on end revenue. This directly affects vertical reinforcement learning startups. You're suddenly competing against a company with 100 times your GPU budget and existing relationships with every major enterprise through platform partnerships. Pillar 2, co-creating apps with SaaS companies. Instead of per-token pricing that commoditizes with every new model release, OpenAI is moving toward revenue sharing and outcome-based models. ServiceNow is the proof. This isn't a license fee or an API bill. It's revenue share tied to value created. Basically, OpenAI is building agents for SaaS companies and taking a cut because SaaS companies realized they are culturally and financially incapable of executing on their own. This aligns incentives with customer success. OpenAI only wins if the deployment works, but it also captures customer upside in a way per-token pricing never could. If your AI deployment generates $100 million in value, OpenAI participates in that value directly, rather than collecting inference fees that might total a few $100,000. Pillar 3, proprietary tech as the tip of the spear. The most important signal in OpenAI's recent moves is this. Some capabilities may never become public APIs. Capabilities like reinforcement learning environments, computer use agents, and voice agents are GPU intensive and expensive to run. OpenAI may reserve these capabilities exclusively for enterprise co-development deals, creating differentiation that API access and open source alternatives fundamentally cannot replicate. OpenAI can be selective about who gets access to their most advanced capabilities. Sam Altman's compute hoarding strategy, all those deals to secure GPU capacity that seemed excessive, now makes sense. This is the real moat. By keeping the most differentiated technology proprietary and deploying it only through strategic partnerships, OpenAI creates a wedge between what's available to the market and what's available to their partners. The net effect of all 3 pillars is this. Deep integration creates switching costs that API access never could. Revenue sharing lets OpenAI capture app layer value directly. Proprietary tech keeps competitors from replicating the offering. OpenAI isn't settling for vendor economics. They're playing for platform economics. If this is the kind of analysis you find useful, subscribe. I do this kind of breakdown regularly. Now let's look at OpenAI's go-to-market org, because an aggressive enterprise push only works if you have people to execute it. A year ago, OpenAI didn't. I lamented in previous videos that OpenAI didn't have enough go-to-market staff to sell to enterprise. roughly 800 solutions architects, customer success managers, and account executives as of September 2025. That was a cultural problem as much as a structural one. OpenAI was content closing inbound leads rather than hunting enterprise deals aggressively. You can't win enterprise AI with product-led tactics when AWS has 10,000 solutions architects who will fly anywhere to close a deal. That's changed in the last 3 months. OpenAI's go-to-market org is starting to look like AWS, a grown-up org chart primed for deep platform partnerships. The evidence: more than 200 job openings for pre-sales solutions architects, account executives, customer success managers, and forward-deployed engineers, all broken into clean swim lanes by function and vertical, healthcare, financial services, manufacturing, every role mapped to industries, strategics, and geos, specializations across every part of the sales cycle, no more generalists. They recently split generalist solution architect roles into pre-sales and specialists. The sales culture is shifting too. Less millennial startup energy, more 30-year veterans who know how to run a procurement cycle. New CRO Denise Dresser, previously at Slack and Salesforce, knows exactly how to build enterprise sales organizations that land and expand within large accounts. Now let's bust the commoditization narrative. Mark Benioff has been telling anyone who'll listen that foundation models are commoditizing while the workflow layer captures all the value. It's a convenient thesis if you're the CEO of Salesforce, but it misreads what OpenAI is actually doing. The argument goes like this: foundation models commoditize because they're interchangeable. GPT-5, Claude, Gemini all perform similarly on most tasks. Value therefore accrues to the workflow and context layer. Whoever owns customer relationships and workflow definitions wins. Salesforce wins. ServiceNow wins. API providers become interchangeable utilities competing on price. This narrative contains a kernel of truth for basic text inference. It completely misunderstands the new engagement model. OpenAI isn't staying in the API lane. The ServiceNow deal proves they're entering the app layer directly, not by building competing applications, but by embedding themselves into the core product and taking economic participation through revenue share. They're not building a CRM to compete with Salesforce. Revenue share captures app layer value. If ServiceNow's AI-powered workflows drive $1 billion in enterprise value, OpenAI doesn't get paid like a commodity API provider billing for tokens. Proprietary tech creates differentiation that can't be commoditized. If voice agents, computer use, and real-time reasoning stay proprietary and reserved for enterprise partnership deals, there's no commoditization of those capabilities. They literally cannot be replicated by competitors because they're not available to competitors. Here's the thing. If LLMs were actually pure commodities, OpenAI would have a problem, but they're choosing not to play that game. By entrenching themselves deeply into customer products through co-development, they become harder to replace with each passing quarter. SaaS companies are incentivized to partner with GPU-rich AI labs, and there's really only 3 of them. They get the compute plus enterprise-grade reliability guarantees and expert help with product and roadmap from some of the smartest people in the industry. Now for the implications. For SaaS companies in the short term, these partnerships accelerate your AI roadmap. ServiceNow gets capabilities it couldn't build itself, deployed faster than internal development would allow. But long term, you risk becoming a policy engine plus workflow database while OpenAI captures the intelligence layer value, the part that's actually growing. For startups, the calculus is bleaker. OpenAI's platform partnerships reduce total addressable market for startups, especially those doing reinforcement learning environments or vertical AI deployments. That said, the market is massive and fragmented. Plenty of room for winners in niches OpenAI won't touch. The bigger risk for startups isn't strategic overlap, it's compute access. If OpenAI is locking up GPU capacity for enterprise partners, startups may find themselves struggling to get reliable inference at scale. We'll see how that plays out. If you can't crack enterprise distribution in 12 to 18 months, the window may close entirely. OpenAI plus a platform partner can deploy repeatable patterns across hundreds of enterprise customers, before you've closed your Series A and hired your first sales team. The rumors are telling. Sierra, a well-funded voice AI startup focused on customer service, is reportedly shopping for buyers. The awkward context? Brett Taylor, Sierra's co-founder, sits on OpenAI's board. So here's the bottom line. OpenAI isn't content being the commodity API layer, while Salesforce, ServiceNow, and vertical AI startups capture the margins. The new engagement model, co-development with platform partners, domain-specific foundation models, outcome-based pricing, proprietary capabilities reserved for strategic deals, lets them capture app layer value directly. It's a win-win for everyone in the short run, but in the long run,